This episode is brought to you by Progressive Insurance. Do you ever think about switching insurance companies to see if you could save some cash? Progressive makes it easy to see if you could save when you bundle your home and auto policies. Try it at progressive.com. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states.
AI had the time of my life. AI never felt this way before.
From building timelines to assigning the right people and even spotting risks across dozens of projects, Monday Sidekick knows your business, thinks ahead, and takes action. One click on the star and consider it done.
And I owe it all to you.
Try Monday Sidekick, AI you'll love to use on Monday.com.
Welcome to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. In this episode, we are going to continue with our series as we reflect on all of the stock market highlights in 2025. This is the perfect time to reflect on the performance of your portfolio last year, identify your goals for 2026, as well as take a look at the emotions that you felt when the stock market had these volatile moments. What did you learn from that experience, and how can you change that moving forward? But before we get into that, let's look at what took place in the market last week. I expected to see some volatility in the market on January 5th, after the capture of Maduro on Saturday, January 3rd. Typically, when we have geopolitical issues, we tend to always see the market take a tumble. It does quickly recover, it's short-lived, but we do see volatility because of the market's uncertainty. I was honestly in a little bit of shock as I watched the market start to climb new all-time highs. I always have to ask myself, what is the market telling me? It's important for us to understand that the market is always hinting at what it already knows. And typically, when it doesn't know something, it starts to drop. And it typically price adjusts to what it anticipates. So for it to be moving towards new all-time highs, I had to ask myself, what does the market know that I don't? What was interesting was all week, stock market analysts were saying that the market was positive and not worried about Venezuela because it was focused on earnings season, which kicks off this week. And it anticipated for earnings season to be great. And so that's what it was pricing in for the week. That assessment still didn't sit well with me. Why? Because we just came off of the results of the Santa Claus rally. If you've been with me for over a year, then you have heard me talk about Santa Claus rally in the past. The Santa Claus rally is basically a historical pattern that takes place every year in the last 5 trading days in December and the first 2 trading days in January. This historical pattern tells us that if we do not have a Santa Claus rally, then we can expect a down year. If we do have a Santa Claus rally, then we can expect a positive year. Last year, we did not have a Santa Claus rally. The stock market, as you're going to hear in this week's episode, did crash in April. Now, it did recover, so it's important for us to understand these types of historical patterns. Things can reverse, things can change, and they're not factual. They're just trends and references that we can look back at and also potentially be aware of what takes place in the future. I did a full breakdown on the Santa Claus rally in our Patreon, patreon.com/investies in our exchange tier. The lack of the Santa Claus rally tells me that there is a potential for a down market, meaning we don't feel positive about where we currently are, which also lets us know that we could potentially have a down first quarter. If people are not feeling good about the market in December, when we are at the height of spending money with gift giving, then potentially we're not going to have a great outcome for earnings reports in earnings season that takes place in the first quarter. So you can understand my surprise that after a geopolitical issue, the market starts to move in a positive direction. Meanwhile, analysts are telling us that the reason there is no volatility in the market is because the market is not worried about Venezuela. It is focused on the potential of positive earnings that will be reported in Q1. However, that is what the Santa Claus rally does. It reports on the strength of the market. And while, of course, I do not take patterns as fact, I did feel like something wasn't quite right, or at least there was a piece of the puzzle that I was missing. And then it dawned on me. How else can liquidity be created aside from lowering interest rates? By increasing the value of the dollar. And how can we increase the value of the dollar? Oil. Oil is another way that we can increase the value of the dollar. Oil is priced globally in US dollars. So when countries buy oil, they usually have to pay for it in dollars. That means that there is a constant global demand for dollars to facilitate that specific trade. Now, when oil prices go up, that can actually strengthen the dollar because more dollars are needed worldwide to buy that pricier oil. On the other hand, if oil prices drop, global demand for the dollars might ease a bit, which can sometimes weaken the dollar. I believe that on January 5th, at the start of last week, we had a rally and reached new all-time highs because the stock market was anticipating the possibility of an injection of liquidity coming into the market via oil prices. Currently, oil prices are in fact volatile. Towards the end of last week, Trump did meet with all of the big oil companies. We still have to see how all of this unfolds, but it is my belief that the stock market was anticipating the injection of money coming from oil. Not that the stock market was all of a sudden feeling positive about the potential earnings reports that we have coming out next week. Enjoy this week's episode of Investies from April 7th as we revisit all of the tumultuous times in 2025. Last week was employment data heavy. We received several reports pertaining to employment in the United States. One of the biggest reports that we pay a lot of attention to is the NFP report, the non-farm payroll report that is published by the U.S. Bureau of Labor and Statistics. This report lets us know how many jobs have been added to the U.S. economy. The non-farm payroll report came out with its job numbers for the month of March. We added 228,000 jobs to the job market. This is very positive considering that analysts were expecting 137,000 jobs. And we are also up from what we added in the month of February, which was 117,000 jobs. So at 228,000 jobs for the month of March, this lets us know that we have a strong job market, and there is definitely stability here. So this is a very positive signal. However, there was some negative information that was also released with this report, as the unemployment rate did increase from 4.1% to 4.2%. While that is a slight move upwards, it is still relatively significant and something that we should be paying attention to. But all in all, I think that the amount of jobs that were added for sure overshadowed the unemployment rate. Job creation was the strongest in professional and business services, adding 57,000 positions to the job market. This is a space where we haven't really seen an increase in, I want to say, several years. Typically, the number that outperforms here is leisure and hospitality. So it's actually nice to see the professional and business services growing. We also are seeing financial activity, which grew from 38%. This most likely has to do with us getting closer to tax day. And then the other sectors that benefited were manufacturing, which increased by 21,000, and leisure and hospitality coming in at 17,000. Typically, news like this would be a strong catalyst for the stock market to increase, whether it impacts it for the day or for the week, depending on how positive or how negative the numbers were. Given that these numbers were positive, it would be normal to see the stock market see a relatively significant jump off of this news. However, the market can't be bothered with employment data. It is worried, concerned, stressed about one thing and one thing only: tariffs. How is the world going to react to tariffs? Are we going to enter a trade war? Is this going to benefit us? Are we going to go into a recession? Are interest rates going to be impacted? Is inflation going to come back stronger than ever? There are so many concerns surrounding tariffs. I don't know that Donald Trump was expecting the outcome that took place. China reacted and they imposed 34% tariffs. This now totals tariffs from China to 54%. We're also very dependent on Chinese production. The market reacted. The Nasdaq crashed, and S&P 500 and the Dow are on their way. Fed Chair Powell spoke and let us know about his concerns that we could be headed towards a recession. However, the market wasn't too concerned that Fed Chair Powell anticipates a potential recession. Why is that? Because if we head towards a recession, this means that there's a strong potential that interest rates will come down. And what does the stock market love more than anything? It loves cheap money. And so now analysts are anticipating interest rates coming down, which does tend to benefit the stock market. So as Fed Chair Powell was speaking last Friday, we did see a bump up in the stock market. Having him speak did sort of stop some of the bleeding from happening on the market. I do believe that if we had negative employment data coming in, then we also would have seen much more pain in the market.
Take the exit. Turn right into the drive-thru.
Nope, I'm making dinner tonight.
You don't have time. Josh has practice.
Oh, that's right. I'll just get a salad.
And fries?
No, just the salad.
But salad cancels fries.
Salad only.
Fries.
Salad.
Fries.
Food noise isn't fair, but Mochi Health is. The affordable GLP-1 source that puts you on the road to successful weight loss.
Hey, can I get the
fries?
Salad. Sorry.
Learn more at joinmochi.com. Mochi members have access to licensed physicians and nutritionists. Results may vary.
This podcast is supported by MIDI Health. Are you in midlife, feeling dismissed, unheard, or just plain tired of the old healthcare system? You're not alone. In fact, even today, 75% of women seeking care for menopause and perimenopause issues are left entirely untreated. But it's time for a change. It's time for MIDI. MIDI's not just a healthcare provider. It's a women's telehealth clinic founded and supported by world-class leaders in women's health. Their clinicians provide one-on-one, face-to-face consultations where they truly listen to your unique needs. They offer a full range of holistic, data-driven solutions that isn't one-size-fits-all care. This is care uniquely tailored for you. At MIDI, you will find that their mission is clear: to help all women thrive in midlife, giving them access to the healthcare they deserve. Because they believe midlife isn't the middle at all. It is the beginning of your second act. Ready to feel your best and write your second act script? Visit joinmidi.com today to book your personalized, insurance-covered virtual visit. That's joinmidi.com. Midi, the care women deserve.
I want to talk to you about the severity of what took place last week, and then I want to get into the numbers. Am I concerned? Your girl is concerned. And you know that when I am concerned, then it's concerning because I love a bloody market. I thrive in this type of market. I think that this is the time when we need to lean in, when we need to be building portfolios. And in the last 5 years, we have had an uptick in marginalized community members investing into the market. And my biggest concern is that there is going to be a panic sell-off from our marginalized community members that have never gone through these types of losses before, and that they will never come back to the market, and they would have cashed out and closed out and lost a significant amount of money. That is my biggest concern. This roller coaster has a steep fall, and it is not going to be for everyone. There's going to be only a select few that are new to the market that are going to be able to sustain the emotions that come with riding this type of roller coaster. Now, let's discuss numbers. When I lay these numbers out for you, what I'm trying to communicate is going to make so much more sense, and you're going to be able to see my concerns. As I mentioned when we opened up this episode, the NASDAQ has crashed, okay? We are down 22% from our all-time high. Quick reminder, if an index or a stock drops by 10%, it officially enters correction territory. Any drop in between 10% and 20% is correction territory. This just means that the market is correcting itself. We want to see the market correct itself. These are healthy moments in the market. Anything below 20% is officially a stock market crash. Period. It's official. The NASDAQ has dropped 22% from its all-time high. It is officially crashing. As of the recording of this episode, the Dow Jones is down 14.63%. Now, out of the three indexes, the Dow Jones is the one that moves a little more conservatively, I should say. It doesn't typically have steep falls. It doesn't typically have really high highs. It is much more steady in the way it moves, but it did free fall. And so we are looking at it as of right now, free falling and headed towards a crash. I'm not going to try to be positive about this. I'm not going to try to sugarcoat it. I'm keeping it real for you today. As of the recording of this episode, it looks like it is going to hit a crash. Now, we're also going to look at the S&P 500. This one is key. When the S&P 500 hits more than 20%, then the entire stock market is now deemed officially crashed, okay? As of right now, we are in correction territory because the S&P 500 is in correction territory. The S&P 500 is down 17.35%. We are just a few percentage points from entering an official crash. Once we enter a crash, this is referred to as a bear market. When we are on an uptrend and we've increased 20% from our low in the market, then we officially enter a bull market. So we're headed towards a bear market. Our all-time high was February 19th of 2025 this year, and our low as of the recording of this episode was on April 4th of 2025. That is 43 days that we have been downtrending. Now, it's important for us to understand that that is a significant drop in a short amount of time. The last time we crashed was in 2021, okay? It was not that long ago. This downtrend lasted 286 days, and we came down 24.5%. It ended October 10th of 2022. So over the course of 286 days, we were continuously downtrending, which is also really hard to sustain because you're continuously taking a beating, but at least in between you have some relatively good days to keep you somewhat positive, but the amount of time is relatively long. So when we compare this down market that we are currently in now, down by 17% versus the 2021 crash, you can see how the experiences are vastly different from one another. You develop different skills as an investor. This potential crash that we're headed towards right now can be too fast, too soon for a lot of people. Really quickly, I want to highlight that the potential 2025 crash, the catalyst is tariffs. The 2021 crash, the catalyst was inflation and the supply chain. And then we have another one that I want us to take a look at that is much more comparable to what we are currently experiencing, which is the 2020 crash. And that one, the catalyst was COVID. That crash was short-lived. We downtrended for 31 days and we dropped 31%. That crash was an incredible crash to be a part of. We quickly recovered and entered a fast-moving bull market. I had never experienced anything like it. In terms of the drop, that is what feels the closest as to what we are currently experiencing. Of course, it is yet to be seen how far the market will come down based on tariffs. We still need to see how Donald Trump reacts in the next few days, few weeks, how other countries react, and if we are in fact going to enter a full-blown trade war. We do not know the outcome of anything yet. I want to quickly go over the last crash I'm going to review. This one is the housing market crash that took place all the way from 2007 to 2009. We hit an all-time high on October 8th of 2007. We started downtrending from there and hit our low on March 2nd of 2009. This downtrend lasted 512 days and we came down 56%. This was absolutely brutal. There were people that lost a ton of money, sold out, and never came back to the market. Historically, crashes have taken place every 10 or so years. So it isn't normal for us to see a crash the way we have in 2020 and 2021, and now potentially in 2025. Now, I will say that what took place in 2020 with COVID, it was an anomaly. It is very hard to measure what took place in 2020 to other crashes because we had a powerful injection of money into the economy. We had extremely low, non-existent interest rates. We had a lot of stimulus checks. We had crazy unemployment money coming to us, and we had nowhere to go to spend it other than online. So I did feel like the 2021 crash was almost an extension of the 2020 crash, where we sort of suppressed the potential crash that needed to take place, and we extended it out into 2021. So I do want to highlight that this isn't normal in terms of market behavior. It could be that market behavior is going to change and that we will begin to experience a new normal. Either way, when we look at a stock chart, specifically take a look at the S&P 500, and we zoom out to the entire longevity of the S&P 500, these are just small moments in time that some people get to be a part of and others do not. I hope that you continue to participate. This isn't to say that you go and invest all of your hard-earned money today. This just means that you slowly continue to deploy money into building your portfolio. And I am of the mindset, especially as a marginalized community member, that I only invest what I can afford to lose. This really helps me manage my emotions, and it helps me understand what I can withstand as an investor and what I cannot withstand and what drives me into panic. As you continue investing, your tolerance will increase. You will learn different lessons throughout the process, and you will become a much more seasoned and better investor. If you haven't read my book, Wealth Warrior: 8 Steps for Communities of Color to Conquer the Stock Market, this is a perfect time to begin reading it. This is also a perfect time for a refresher if you've read it already. If you have close friends and family that have not yet read the book and are interested in investing, share your book, recommend it, have them go to the local library and check it out. This is the perfect time. I really believe that the book also really helps you stay grounded during the process from a logical perspective, but also understanding how to deal with your emotions and any scarcity mindset that you have with letting go of money or watching your portfolio lose money. Highly, highly recommend refreshing yourself on it. You're listening to Investies podcast. I'm your host, Linda Garcia. If you are finding Investies podcasts beneficial, I want to ask you for one of the greatest gifts that you can give a podcast host. I want you to go to whatever application you listen to this podcast on, and I would like to ask for you to take 5 minutes of your time to rate and review this podcast. It really helps to amplify the podcast and surface it to other listeners. It also helps potential listeners get an idea of how this podcast is beneficial. Please, please, please head over to the podcast application, rate and review us. I greatly appreciate it. This is a Cosmic Standard and In Lose We Trust production. A very special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.